Good evening, everyone. Welcome to today's webinar. My name is Sara, and I have over 12 years of experience in the financial markets, both as a prop trader and as an educator. My expertise is across derivatives trading, currencies, commodities, and stock indices. And I'm licensed from FINRA in USA and from ESCA, Securities and Commodities Authority in the UAE as an investment manager. Over the years, I've had the opportunity to mentor individuals from a wide range of professional backgrounds to help them develop different effective strategies, to help them implement risk management in their trading, and to build discipline for long-term consistency and for wealth management. Before we begin, I would like to introduce you to Amana. So, Amana is a leading brokerage with a 15-year track record of providing clients with a world-class trading experience through the best possible executions, technology, and a dedicated customer support. We are regulated both locally and internationally. So locally, we are regulated from DFSA and from CMA, previously known as SCA. And from Europe, we're regulated through SISEC. And we also have the Lebanese regulation CMA, and we have LFSA from Malaysia and FSC from Mauritius. So we have these multiple regulations. In terms of the assets and the instruments that we offer, we have a strong focus on the MENA region. So we provide access to both regional and international stocks. Through our platform, you can trade more than 5,500 different instruments across stocks, commodities, currencies, indices, ETFs. So we have both leveraged and non-leveraged instruments. We also offer something called Amana Invest, which allows investors to access professionally designed portfolios that do not require active management, and they just help to build your portfolio over time. So if you have any questions, you can get in touch with us through our email, which is support@amana.app, or you can call us directly. You can visit our website. You can get in touch with your relationship manager. We also have a live chat on our website. So before we get started, I want to share with you two exciting promotions that we are having at Amana. So the first one is this weekly iPhone 17 Pro Max giveaway. And I have talked about this promotion in my previous webinar. So this promotion will last till the end of this month. And this is open for both existing Amana users and for new app users. And to qualify, you just have to deposit a minimum of $200 in your trading account on the Amana app. So this promotion and the next one are both relevant just to the Amana app, not to the MT4, MT5 trading platforms. So you have to deposit 200 and then just execute one trade, and that's it. So we have winners which are selected weekly, and every week one winner will get an iPhone. So as long as you have this amount of money in your account and you just execute one trade every week, you're eligible for this draw. And so we have the next draw on the 22nd of June, and the one after that is on 29th. And the second promotion is the Amana FIFA World Cup prediction promotion, which is a very exciting opportunity for you to predict the FIFA World Cup champion and actually share a 1 million prize pool. So yeah, Amana is giving a $1 million prize pool as trade credits. So to participate in that, you just have to register on the Amana app. So if you don't have the Amana app, just download it, register on it, submit your prediction for the winner of the World Cup, and you need to deposit a minimum of $1,000 in your trading account and execute at least one trade. So predictions have to be submitted till the 5th of July, and the total prize pool is $1 million, and this is going to be shared equally among all the winners, whoever have predicted the World Cup champion, and this will be as bonus credited into your trading account. So, for example, if there are 100 people who have predicted correctly, so 1 million divided by 100 is $10,000. So, $10,000 will be credited into your trading account, but this is not withdrawable. This is just a bonus credit, and any profits made on top of this is withdrawable. So, there are terms and conditions, and you can go through that on our website. And I'm just also going to paste this link for you on in chat. So, I hope that you can see this. Yes. So if you have any questions, please share them in the Q&A section, not on chat, okay? So I will try my best to answer them as we proceed with the webinar. Okay. Now, this is one of my favorite topics, and this is the biggest mistakes which traders make. And I'm sure that you have guessed by now that this topic relates to trading psychology and trading discipline. So before I actually begin, I just want to say that I know without even asking that anybody who trades has had one experience which is, common across all traders, and that is you had the right view about the market, you had the right prediction about the market, you were 100% correct, but you still lost money, right? So there could be so many reasons why this may have happened. There could be numerous reasons. One could be maybe you entered too early, or you entered the trade too late for fear of missing out, or maybe you just, increased your position size, or maybe you just, moved your stop loss when you didn't, or perhaps you were in that, revenge trading mode, or, you were on a winning streak and you did not calculate your risk management, you didn't do your risk management properly. So there could be a lot of these reasons. So the reality is actually that traders don't fail because of strategy mostly. They don't fail because they fail to predict the market. They don't fail because they can't read the market properly. They don't have a correct strategy. They fail because they struggle to consistently execute their trading strategy. So, in other words, the problem is with the trader's own mind. The problem is with the lack of discipline. And in my experience, after working with traders from different backgrounds and different levels of experience, I found the biggest difference between profitable traders and unprofitable traders is not really market analysis or intelligence or knowledge at all. It's not the ability to predict the price movements, it's just discipline. And that is it. It is just how well they stick to their risk management principles and to their original trading plan. So trading is basically is one of the few professions where having the right analysis is absolutely not enough. You can be absolutely right about the market direction. You can still lose money if your risk management is poor. On the other hand, you can be wrong many times and you will still not get hit. Or you could still actually end up making profit if your discipline and risk controls are strong. So let us begin. And before we begin, read this disclaimer in front of you. So again, the real reason that most traders fail is that most traders believe that we failed because we couldn't predict the price. But that is not the reality. The reality is the majority of losses come not from bad trades, but your own behavior. And performance actually degrades when emotion overrides the process. So there is a study by Professor Baba and Odin that actually examined about 66,000 brokerage accounts of successful traders. And these were both active traders and passive traders. So they were active traders who were trading daily or weekly, and then they were passive traders who just left the money in the account and did nothing, just invested them in some instruments. So what they basically found was that active retail traders were underperforming the passive investors. And the reason was not because they were wrong. The reason was because they repeatedly made these predictable behavioral errors like overtrading or holding out on a losing position for too long, chasing performance, over leveraging, acting out on their emotions, not managing the risk properly, and so on. So that doesn't mean that active trading cannot be successful. It just means that what you have to understand is that success in trading is less about predicting the market or understanding the market, and it's more about managing yourself. So the more you're able to manage yourself, the better is going to be your trading results. So, in this webinar, I have actually listed about 10 main behavioral mistakes that traders make, and we could just broadly classify them into three types of mistakes. One would be directly linked to risk and management of risk. The second is linked to execution, and third is linked to psychology. So indirectly, all of them are linked to your psychology and trading discipline. But just to classify, I have categorized them into three. So again, if we move on, most of the legendary traders like Warren Buffett or Alexander Elder, if you look at the advice that they imparted, for example, we have Alexander Elder who said that successful trading is 80% about psychology and it's only 20% method. And if you know about Warren Buffett, he said that the most important quality of a trader is patience and temperament. It is not intellect, it is not market prediction. And this saying of his is very well known. Then we have Mark Douglas, who wrote this book, Trading in the Zone, which became very popular. And he writes in this book that the consistency that you seek in the markets is not in the markets, it's in your mind. So the markets are always going to remain unpredictable. So don't try to think that you can predict them always. But what you can predict is your own self, is your own behavior. So what is in your control is you, yourself, your mind. And what is not in your control is the market. So the best thing is to control first what is in your hands before you actually, try to predict the market. So none of them talked about like indicators or strategies or something or special chart patterns or this or that. They just talked about discipline, about emotional control, about like consistency. So let's move on. So the first and the biggest mistake, which actually is linked to a lot of mistakes, is ignoring your risk management. So I have discussed this several times in the past as well, that I consider this to be an integral part. It's just something intertwined with your psychology. It's just goes hand in hand. It's nothing separate. Your risk management and your discipline just are completely intertwined. And I will repeat this for any new people who have joined the webinar. So the way that we calculate the risk per is, first we have to define a risk per trade, which means the dollar amount of risk that you want to take on a single trade. Now this should be approximately around 2% of your account's value. For example, if you have a $10,000 account, so the risk per trade should approximately be around $200. And this is something you can apply to smaller accounts and bigger accounts. Now, this is just a reference. I know that there can be people who may want to risk more because they have more money or they have different objectives. And there could be people who might want to risk less. And the dollar risk per trade also depends on how frequently you trade. Somebody who is trading less frequently, like they just want to take one trade in a week, they may want to increase the amount. If you're trading more frequently, you may want to reduce this amount. This amount also depends on your overall risk exposure. What that means is, if I have 5 trades open and I have 2% risk on one trade, that is a 10% exposure with 5 trades open. So we not only have to look at the risk per trade, we also have to look at the overall exposure. In my opinion, your overall exposure should not exceed 10% of the account's value at any given point in time. And your risk per trade should be, ideally, as a beginner with little experience, should be somewhere around 2%. A little bit more or a little bit less does not matter. Okay. Like I said, it also depends upon a lot of individual factors. But what is good about having this amount is that you have to before you decide on the risk per trade, just assume that you will have 10 winning, 10 losing trades in a row. Assume that you will lose 10 trades in a row. What that means is if I risk 2% per trade and I lose 10 trades, I am losing 20% of my account. Okay. This really helps because a lot of beginners will make a lot of mistakes in the beginning, and usually that's due to discipline issues and not being able to manage risk management properly. But sticking to this rule gives you an advantage, and that advantage is that even after a long losing streak, you still have 80% of your capital preserved, and you can recover your money. So this is one rule that I used to follow when I started trading, you know, and obviously now I am a more experienced and a more confident trader, so I can actually invest more or risk more on a very good setup. But that does come with experience. With experience, a lot of things, and you build a lot of discipline. You can recognize trading setups better. You can manage your risk better. So, but again, if you're a beginner, you should definitely risk around, this much, around 2% on a single trade. Then what do you do next? The next thing is you have to pick a stop loss level. We've discussed this before, and I will repeat this for any people who are new. So I'm going to S&P 500 right now in front of you. And we just saw there was, so this is the weekly time frame. Let me go to the daily. So we had this nice dip, and then we have this bullish engulfer, which was a potential entry point in an uptrend, right? So what I'm going to do is I'm going to put my stop loss below the swing point, right? So the chart should be the daily time frame, D over here, which is a bigger time frame, which allows you to look at the trend over a few weeks to a few months. We put the stop loss when the price dips down in an uptrend, it retraces, and then it gives you a buy signal in terms of a price action signal, which is right here, which is these two candles. I will zoom this chart out. So yes, these two candles, this is a bullish engulfer, which showed us that, bulls are back in the market. They might push the prices higher. So what we do is the stop loss is going to go right beneath this swing point on a higher time frame, which is the best stop loss placement. Next, once we have decided the risk per trade and we know the stop loss level, the risk management is done in the following way. We have to calculate the position size or the quantity traded. So we don't select any random quantities to be traded. The position size or the quantity is given by your risk per trade, the dollar risk on the trade, which is fixed, divided by your stop loss size, right? So the stop loss size is basically, what is the stop loss size? The stop loss size is basically the market price or the execution price, the entry price, I should say the entry price, minus the stop loss price, right? So here I have my, if we assume, just assuming we entered at market, then the stop loss size is going to be 7551 minus 7147. The position size is, so let me just do a calculation for you. This is going to be a very wide stop loss. So let us assume that we entered on the close of this particular candle. So going back in time, let's assume we entered when this candle closed. I saw the signal, and so the stop loss size is going to be my entry price, which is 7397 in this case, minus my stop loss, which is 7147. So that's 250, right? So your stop loss size is 250 points. So assuming that there's a $10,000 account and the risk on the trade is $200, what I'm going to do is the risk is 200 and the stop loss is 250. So the risk is $200, the stop loss size is 250 points. And in this case, what is going to be my quantity? It's 0.8. Okay. So what this means, if I have to buy, I will change this amount to units here and I will write 0.8. So I think that, yeah. So if I buy this much, then if my stop loss is hit and I'm wrong, I will lose exactly the risk that I have planned, which is $200 at my chosen stop loss. So this is how we do our risk management. And it's a very simple formula. Again, your dollar risk on the trade divided by your stop loss size. Okay. And the quantity that we choose to trade is not a random quantity. It is a calculated quantity based on your risk per trade and based on your stop loss placement. Okay. Now, most traders are actually not following this rule, or they are confused about how to manage the risk, or they are putting stop losses wherever they want to. They're not putting it at a proper level, not putting it at an invalidation point where they're, where their market thesis is completely invalidated. In this case, you have to understand that you have to put stop losses below or above swing points on higher time frames, which will be like the best stop loss placements, which will reduce the chance of you just getting stopped out just because of the market noise or smaller fluctuations. So I have discussed this rule with you. The first thing is to restrict the risk per trade to a certain value, and then to consistently execute the same risk on all of your trades. So it's not like if you are risking 2% on one and 3% on another and 5% on another, that is not going to work. The next thing is that there are actually two things in this formula. It's not only the risk per trade, it's also your stop loss. So unless you put a stop loss, you just cannot do risk management. There's no concept of doing risk management without putting a stop loss. And I will keep repeating this again and again, that if you are trading on leverage, please start putting your stop losses and start doing your risk management. Otherwise, I'm sorry, but there's no long-term survival method in the market. I know a lot of traders they don't put stop losses. They think, we will be stopped out of no reason. But that does not happen if your stop loss placements are correct. That can happen sometimes. But when it does happen, then you have to admit to yourself that you were wrong. And it's okay to take that loss rather than hanging on to that trade and increasing your losses. Some traders do what is called averaging, which means as the market keeps moving against them, they keep adding to their position, thinking that we will reach an average price. And in my experience, that is the number one account killer. That's the number one way that you can actually wash away all the money that you have. Because it might work once or twice, but it will not always work. And when you're caught up in a trend, it will definitely, adding to your position size while the market is moving against you, trying to find that average price, that might not happen at all. So the most clearest way is fixing a stop loss at the right point, going in, and then just understanding that if the stop loss is hit, that is the end of the story, that is the end of the trade, and I will just come out happily with the loss that I fixed on that trade. Again, some people will not put a physical stop loss. They will just put like, a mental stop loss. Say, okay, the price comes to this, I will get out. Again, that makes it things very uncertain, very unpredictable, because that's called holding a naked position, which is a position without a stop loss. So, a lot of things can happen, which can be gaps, news events, platform issues, crashes, anything can happen without warning. And if your trade is open, then you have to just bear with the repercussions of that. So again, there is nothing more important than putting a stop loss and doing the risk management and doing sizing yourself correctly. So let's move on to mistake 3, which is again related to your stop losses. So the funny thing is that a lot of people, what they will do is, after having shown you this calculation of the stop loss, of the position size, what they will do is, in a buy position, they could just push the stop loss down, thinking that they want to be in the trade, they want to stay in the trade for more, or because they're afraid the stop loss will be hit. So actually, this is absolutely, not allowed, because your risk management, the calculation of your position, your quantity was based on this stop loss, right? If you're pushing your stop loss down, then you're just completely messing up your risk management. You're just basically increasing your risk. So I mean, you're not actually practicing any risk management, if you are pushing your stop loss in this way. Yes, you can push your stop loss in a favorable way, which means if the trade moves up and it moves in your direction, I could actually change my stop loss and put it to break even. So this is actually a good strategy, and you should definitely be doing this. And I've discussed in my previous webinar on risk rewards that if you get at one times the reward or 1.5 times the reward as your risk, you can definitely trade your stop loss up to break even and make this a riskless trade. So it's a trade now running without any risk associated because the stop loss is now at break even. And I also discussed the ways to trail it, how quickly to trail it, when not to trail it, etc. That's all in my previous webinar. You want to, if you've missed it, you can actually access it on Amana's YouTube channel where we are uploading all the previous webinars. Okay. So I have a question from Mr. Ahmed, who has asked me, for people who invest and not trade without stop loss, what percentage of their portfolio should they invest per asset? So there's a difference between trading and investing. Trading is usually done with leverage, and it's both ways. With leverage, you can actually go long and short as well. If you're investing, that is usually done without leverage, and it's done on the full value of whatever you invested, like ETFs, stocks. Okay. And usually people don't, you can actually put a stop loss on it, but people will not usually don't put a stop loss because the fact that there is no leverage makes it much less risky. So what percentage of your portfolio should you invest per asset? Actually, that is completely dependent on your own objectives, on your own analysis. I mean, I cannot say it unless you tell me which instruments they are. So I will give you an example. If it's a single commodity or a single currency or a single stock, then I believe you should be diversified. So not all your money should be going into that. But if it is an ETF, which by its very nature is diversified, such as, so an index such as S&P 500 or NASDAQ are by their very nature diversified because they themselves contain a group of 500 companies or a group of 100 companies. For such instruments, where there is diversification by their own structure, you could actually allocate a bit more to such instruments because they themselves are diversified. But if you are, trading on like some particular stock, let's say SpaceX, or let's say any particular uh, crypto asset, Ripple or Ethereum or something, then definitely you should have you should diversify. I know that sometimes people feel very strongly about a certain market. People right now have strong feelings after the SpaceX IPO. Some people are very positive about it, some people are very negative about it. But again, that should not make you put all your eggs in one basket because that can be very dangerous. I know traders who have put a lot of money in Bitcoin and are now not happy about it. I know people who bought gold at the top and are waiting for that to resume trend. So again, diversification is completely necessary even when you are investing. But if it's an index, then that, because it's diversified in itself, that you may actually allocate a larger part of your portfolio to that. And then actually, really depends on the instruments that you are investing in. So I hope that answers your question to some extent. So let's move back our webinar. Next, we come to overtrading. So overtrading is again, coming from the mindset that the more you are involved in the market, the more you're doing something, the better are the results, which is very, if you look at it from a rational point of view, it seems that, we are always told that, work harder, do more, and you will get better results, right? And it's counterintuitive if I say that if you do less here, you might actually get good results, but this is the case. Here, being more selective gives you better performance and better results than being more selective, which means trading less gives you better performance and better results. So actually, if we look at the biggest and the most successful traders, and if you look at their portfolios, they are actually trading 5 times a week at most. And these are active traders and with very tight risk management. So that means that they are being extremely selective about what they are trading. So instead of taking 5 trades, they are just taking 1 trade. And why does this overtrading happen? It happens because when you are not trading, you just feel something is wrong. You want to be in the market because maybe you are missing the market. You have a fear that you will miss out on something, on a move. But you must remember that the market is always moving and the market is always going to be there and the market is not going anywhere. Now, after, you know, 5 months or 5 years or whatever, the market is still going to be there. So if you understand this, and the opportunities are going to be there. So I started trading in 2012. And I too sometimes feel like, when I look at a good setup and I look at a good opportunity, I feel like I'm not going to get this again. I need to do this now. Yeah. And that feeling is always there. That feeling has been consistent for the last 10 years. I'm not gonna get this kind of setup again, but I get it again and again and again. So this is something you have to understand that if you feel like you missed out on something and you enter the trade late at the wrong price when the move has already happened, when the move is exhausted, that's a fear of missing out and you are just trading when you shouldn't be trading. So you overtrade because you have a fear of missing out. That's the biggest reason. You might be overtrading because you recently lost money and now the only thing that consumes you is, I want to recover the money. You don't care if there's a setup or not. What is in your mind is, I've lost this much, I have to get that back. So you just jump in the market and you just try to recover those losses. So that's revenge trading. Or even if you are on a winning streak, your mind will tell you you cannot be wrong anymore. You are overconfident. The overconfidence again leads to overtrading. So there are actually so many different mindsets which all lead to trading. So being anxious will lead to trading, more trading, losing will lead to more trading, winning is going to lead to more trading, and so many different types of psychological traps which are both negative and positive will push you to overtrading. What is the best way to overcome it? I think the best way to overcome it is, especially as a beginner, you might want to restrict the number of trades that you take in a week. So you can challenge yourself and say, no, in this week, I'm only going to take these many trades, and I'm only going to take the trades which satisfy all of these criteria. And I'm not going to touch a trade which doesn't satisfy my 3 or 4 criteria. And journaling, I believe, is a very good way. I have journaled a lot. So right before you enter a trade, you can you can just record in your journal what were the reasons that made you enter. So the market structure has to be there, the right level has to be there, the price action has to be there, the risk management has to be done. So after you've checked for all of these factors, then you enter the trade, right? And your journaling is going to actually reveal your behavior to do. Even if you do that for 10 trades, even if you journal 10 trades, you will see a pattern. Where are you the weakest? What is it that you do wrong? What is it that you consistently keep doing wrong? And a lot of times it will be, I just jumped into the trade when, one of these entry factors was not present and it was not looking perfect. So what I've learned is that there will be setups which look perfect, which look amazing, and there will be setups which look okay. And it is always wise to leave the okay setups and just wait for those amazing setups, because those are the ones where you really gain, where you're gaining 8 or 10 or even 15% just from a single trade. So if you went for the okay trades, those okay trades are going to take away the gains that you made from the good trades as well. And I'm sure a lot of you have experienced that. The next one is screen addiction, and very common once you have an open trade. Okay. And that definitely results. So the more you have risked on a trade, the more you will be watching a trade. And if you have done your risk management properly, and if you really know that this is the maximum I can lose on this trade, this is going to relieve you of that, of trying to watch the screen again and again. The more anxious you are, the more you will watch the screen. And what makes you anxious? The fact that you don't know how much you can lose. If you have fixed what you can lose, and if you're comfortable with what you can lose, then the need to watch the screen will fade. So there is something called a sleep test. You may have heard about it. It's a test to gauge if you've done your risk management properly according to your own objectives. And the sleep test simply says that if you can easily sleep and peacefully sleep with all your open positions, then you have done your risk management right. But if you are disturbed and if you are nervous, then you have actually risked more than what you are willing to lose. So this is interesting, but it's actually true. So again, you can relieve this screen addiction by not overtrading, by putting your stop losses, by doing your risk management correctly, and by journaling. Another thing is poor exit planning. I had a whole webinar on exits, that once you have entered the trade, how you should be exiting it. Now, there can be two exits. Either your stop loss gets hit, or you go into profits and you come out with certain. Now, the exits have to be planned in advance. So whenever I start a trade, I do know what is my risk on this trade. I do know this is my stop loss, but I also have a certain vision about how much profit I can make from that trade. So ideally, I would like to have twice the reward or more. So if let's say I've risked $500 on the trade, ideally I'm looking for $1,000 or more. That's just an example. Okay. After the risk reward, definitely I'll be looking at the price action, how every day's price action unfolds. And if I feel that the price action has become negative or unfavorable, then that could be a reason why you could be exiting the trade. So look at your risk reward multiple, look at the price action, look at if there is any impending support or resistance which might affect your trade. And do not exit based on an emotional reason. So don't exit because you are afraid you will lose this profit. If the trade is going well, if the trade is going in your favor, do not exit it just because you feel I'm going to lose this money which I've made. Because the most money is made from the best trades, and we have to keep them running, and we have to take the best out of that. So if a trade has a potential of giving you 10% or 15%, then it's not justified if you just come out with a 1% profit because you feel, okay, I'm just going to take this because I'm afraid of losing it. The only reason why you exit a trade could be because there is a proper reason on the chart. The market gives you a proper reason to exit, which might be some very strong contrarian price action signal. Yes, in that case, you can exit early, but you cannot exit early just based on what you're feeling, just based on your emotions. Okay. I have another question from Mr. Ahmed, who is saying that I have a question about price action. I get confused which type of candlestick I should look at or what pattern I should look for executing my trade. I have had about 3 webinars previously on price action, and right now I cannot go into that. But I would say the best setups could be rejectors or wicked candles. It could be engulfers. It could be inside bars and such setups. So you don't actually have to act on a lot of setups. There are just a few price action setups which are high probability. And I have discussed them in length in these webinars, and you can find them online on YouTube. So that is going to help you. So let's move on to mistake 7, which is emotional trading after losses. And this is called revenge trading. And this happens when you have consecutive losses, and that just makes you very upset. It makes you lose your mind. And you just become angry, you become anxious, you want to recover the money as quickly as possible, which makes you abandon all kinds of rules, all risk management rules, or all rules related to entry or setups or whatever. And again, Being aware helps. Once you are aware about how your psychology works, you can manage your emotions better. So, what I suggest to somebody who has had consecutive losses is the first thing I mentioned was restricting your risk per trade, which means that if you have a streak of losing trades, you are not in a very bad position. Like I gave the example of a 2% per trade with even 10% trades gone wrong in a row, you lose 20% of your account and 80% of your account is still there, right? Second thing is if you feel that you are continuously losing, take a break from trading. Just stop trading and distance yourself from the screen and take as much time as you want. You can be away for a day, for a week, for a month. It's imperative. And just focus on something else, distract yourself until you feel completely normalized and you feel that you are at this you're feeling like you're not affected emotionally, and that is when you can think clearly about your next trade or how you're going to go about, because if you have lost recently, that can really affect your ability to trade. So taking a break and distancing yourself for whatever amount of time that is required is a very good strategy, which will help to prevent this kind of revenge trading. The next is the opposite thing, which is when you make a lot of profit. So that actually leads to the same mistakes that losing leads to, which is again overtrading, which is becoming confident, which is thinking that you cannot go wrong. So you have a false sense of certainty after winning streak. So I read in one trading book a very interesting fact, and that fact said that if you have three winning trades in a row, your mind after that your mind becomes 100% certain that you will win the fourth trade. So 100% certain. That is the amount of confidence you get from a winning streak. And there's a very famous trader, Jesse Livermore, and he wrote in his books that I made my biggest losses after I made my biggest wins, which means that your confidence is not going to be rewarded. In the market, you have to be as humble as possible. You have to treat every trade independent of your previous result. Every new trade should not be dependent in any way emotionally or otherwise on your previous trade. So, however you did on your previous trade is not predictive of how you will do on your next trade. So, again, being aware of these emotions is going to help you to manage yourself better. Then we have the fear of missing out, which everybody has experienced. Again, it's, when you look at other people making money and you hear, okay, this guy made this much money or my friend made that much money, and you just feel like, I am left out, and I need to just start doing what they're doing. And again, when this happens, most probably you end up buying at a price which is not the right price. The move has already happened, the move is exhausted, and now you're just joining at that point where profit taking will happen, where the market can actually consolidate, where the market can change direction, and that just makes things worse. So what the way to overcome this is, again, be very selective about the price level. So I have experienced this many times myself, and what that has led to is me jumping in the trade at a price that was not the ideal or the optimal price, which affects your risk reward. It makes your stop losses bigger because the more your entry is closer to the stop loss, the more risk reward. And the bigger the stop loss size, the lesser is your position size, the poorer is your risk reward. So again, this is something that I know it's very difficult to overcome, and we all have experienced it and we continue to experience it. But letting yourself know that you will repeatedly get very good setups from the market, and the market will repeatedly keep giving you these opportunities, and the market is not going anywhere. And these opportunities will present themselves every week, every month. If you keep telling yourself that, that is going to help you not to jump in the market when the move has already happened. And then we come to the last mistake, which is chasing the market price, which is again very much like FOMO. It's you entering from the fear of missing out. So I'll just give you an example from the platform which will help you understand this better. That what, and this is related not to investment, but it's related more to active trading. So if you are an investor and if you're a long-term investor, then I understand that the timing does not really matter that much. And you have like a long-term perspective of the market. So in that case, the timing or the retracement or the levels does not matter. But if you are an active trader, even if you are a swing trader, then definitely the price levels and the timing do matter. So as an example, what might be a good thing to do would be that once the price retraces, you enter around retracements and you don't enter at the market tops, right? So this is again the S&P 500. This is one of my favorite markets. And what we do is the best thing is to wait for any type of retracement, whether it's big or small, and then wait for a positive price action signal and then buy. Okay. Yes, buying at current levels might still give you profits. But the fact that the stop losses, the best stop losses have to be placed on the swing points would actually make your stop loss size very big and translate into a smaller position size if you have to play safe. So how do we overcome this? One way is to use limit orders, which I've explained before. So what are limit orders? Limit orders allow you to buy at a price which is lower than the current market price. So it's like a pending order. And if you don't like the price, if you think my price is too high right now, don't jump in the market. Instead of jumping in the market, put a buy limit order. So if let's say the price is at 7541 and you would ideally like to buy maybe 200 points lower. So I will go here and I will change from the market price, I will input my own price. So I can input, let's say 7341, which is 200 points below, right? And I'll put some random amount, whatever, or random units. So this is just an example that I'm giving you. So this is not the market price. This price is below the market price, but this order is called a pending buy limit order. And I can put my stop loss here as well at the same time as I'm putting the limit order, which is the best possible thing. So if I put my stop loss at 7,200, for example, and then just confirm this. So anytime that the price comes to this lower level, this order will be executed. And you can see this pending order under orders here. And this order can also be canceled. So if you want to just cancel this order or modify this, if you want to change the price, you can do it later on as well. If you want to change the stop loss, you can do that as well. And yeah, if you want to cancel it altogether, you just change your mind, you can just go here and you can close this. So yes, so you can actually counter this fear of missing out by placing limit orders. And if you want to know what is the chance that most limit orders will be filled. So I trade on the daily time frame where obviously the stops and the limits are going to be bigger than intraday time frames. And I can tell you with confidence that limit orders get fulfilled about 80% of the times with the kind of time frame that I'm using, which means that the market doesn't actually rush in one direction. It does dip back a lot more than what we understand or what we expect, because the market has this mean reversion principle. So it will create zigzag moves and average, it will tend to its mean. And in doing that, it can trigger your limit order. And there have been so many times when I entered at a higher price, and because I was afraid that if my limit order will not be triggered. But I think that more than 70% of the times when I have not done that, I have regretted it. because the market does tend to go back and retrace and just tend to retest those levels. So I'm talking with reference to the higher time frame. So obviously, if you're working on the lower time frames, that the retracement would, it would work even more over there. So this is just a summary of all that we have discussed, all the different types of mistakes that traders make. And we've also discussed different ways of how to overcome them. So I know that most of us, find it very difficult because this is related to our emotions, and emotions are an integral part of being a human being, and we cannot completely take out the fear and the greed in us or the exhilaration or whatever. But what we can do is we can become more aware of it and we can actually manage it in a better way. And just to do that will actually improve your trading results by a great deal. So this is it for today's webinar, and I hope you enjoyed it, and we will meet next week, same time. Thank you. Yes, before going, I just have a question from Chris. So would you advise trading SpaceX? Actually, I think that, if you're talking about a specific stock, it has to be, it's very particular to your analysis, and it's very particular to how you are looking at it and what you are predicting. So I cannot advise you like that if you want to trade SpaceX or not. But what I can generally tell you is that the IPO price, as we know, was, 1.77 trillion. Right now, if I just check the price, the last time that I saw it, it was 214. So let me just see what is the price here. It's 270. Okay. So there are actually two perspectives. One perspective is to buy it right now, and a lot of people are, believing that, it will continue to rise in the future, which I think is, it seems likely as a long-term perspective, because looking at what the company does, looking at its different revenue streams, investment in satellites and defense contracts and this and that, I think that, it is something which very powerful. And I can't deny that it's not going to, become a market leader. I think it definitely will in the future, but how long that takes, I don't know. The second thing is that, as we all know, this company is going to be included in the NASDAQ 100 in somewhere early July. So, in the first week of July, this company will become part of the NASDAQ 100. So one approach could be, if you are interested to trade, yeah, you could trade it directly, or you could just invest in NASDAQ 100 and get indirect exposure to SpaceX in a diversified basket. So looking at the valuation right now, it will definitely make up 7 to 8% of the index. So that is a way of getting exposure to this, like a limited exposure, while not being completely exposed to this. And the other way is obviously that, you just, invest a certain amount of money, like directly in shares. So there are like a few things which I can discuss, but I don't have the time. And I will take this up in the next webinar, because the next webinar just focuses on trading the current market opportunity. So I am going to be discussing more about SpaceX in the next webinar. So thank you so much, and I'll see you next time.